Imagine waking up every morning and finding someone had taken a few coins from your wallet. Not enough for you to notice. Not enough to make headlines. Just a little bit. Day after day. Year after year. Now imagine the person taking those coins wasn't a thief. It was the economy. And the strange part, it wasn't even hiding. Your bank statement kept telling you that your money was growing. Your balance went up, but your purchasing power went down. For millions of people after the 2008 financial crisis, this wasn't just possible, it was reality. So, how does a number go up while you actually get poorer? Stick with me. Most people believe a savings account is the safest place for money. The balance doesn't fluctuate. There are no scary stock market crashes. No dramatic headlines. Every month you earn a little interest. It feels responsible. It feels smart. It feels safe. But what if safe was the biggest lie in personal finance? What if your money was quietly losing value every single year? Not because your bank made a mistake, but because the system was designed that way. Designed by who? Let's do the math first. Then you'll want to know. To understand this, imagine you have $10,000 sitting in a savings account. Your bank pays 0.5% interest. At the end of the year, you have $10,050. Looks like a profit. Now, suppose prices throughout the economy rise by 2.5%. The groceries you bought last year cost more. Rent is higher. Insurance is higher. Restaurant meals cost more. Everything became just a little more expensive. Even though your account grew by $50, the things you want to buy became $250 more expensive. In reality, you're about $200 behind. Your balance increased, your buying power decreased. This is called a negative real return. And here's the part banks never put on a billboard. And after 2008, millions of savers experienced it year after year. Here's the math that many people never learned. Real return equals savings interest rate minus inflation rate. If your savings account pays 0.3%, but inflation is 2%, your real return is negative 1.7%. It doesn't feel like losing money because the number in your account gets bigger. But what matters isn't the number, it's what that number can buy. Money is only useful because of what it can purchase. If purchasing power shrinks faster than your savings grow, you're becoming poorer even while your account balance rises. That's one of the most deceptive financial illusions in modern life. So who benefits from an illusion like that? Follow the money, literally. So why did this happen? Why would banks pay almost nothing? And why did this continue for so many years? The answer starts with a collapse most of us remember, but not for this reason. The answer goes back to the financial crisis of 2008. The global economy was collapsing. Banks were failing. Credit markets froze. Businesses stopped investing. Consumers stopped spending. Fear spread everywhere. Governments and central banks were desperate to prevent another depression, so they reached for one of their most powerful tools. Interest rates, one lever, one decision, and it would quietly reshape millions of bank accounts for the next 10 years. Central banks slashed interest rates to levels that had rarely been seen before. In many countries, they stayed close to zero for years. This wasn't an accident. It was intentional. The goal was simple. If borrowing becomes cheap, people are more likely to buy homes. Companies are more likely to build factories. Businesses are more likely to hire workers. Consumers are more likely to spend instead of waiting. Economic activity increases. Growth returns. From the perspective of policymakers, encouraging spending was essential for recovery. But every rescue plan has a price tag. Someone has to pay it. But every policy creates winners and losers. Cheap borrowing helped homeowners refinance mortgages. It helped companies issue debt. It rewarded investors willing to take risks. Meanwhile, people who simply kept cash in savings accounts saw almost no return. Their money stayed safe from market crashes, but it wasn't safe from inflation. The economy was encouraged to spend. The saver paid the price. And it gets stranger. This wasn't even the side effect. It might have been the plan. Here's something many people never realized. Your savings earning almost nothing wasn't simply because banks were being greedy. It was part of a much larger economic strategy. Central banks accepted moderate inflation while keeping interest rates very low. The idea was that holding cash should become less attractive than investing or spending. If money loses value while sitting still, people have an incentive to put it to work. From an economic perspective, that can stimulate growth. From a saver's perspective, it can feel like being quietly penalized for doing the responsible thing. This leads to a fact that should honestly be more famous than it is. This leads to one of the most surprising facts about the last decade. Inflation versus savings rate. Traditional bank savings accounts produced negative real returns for a decade after 2008. Think about that. A full decade. Let that sink in before you check your own account. Millions of people believed they were protecting their financial future. They deposited money every paycheck, watched the balance slowly climb, avoided risky investments, made sacrifices, delayed vacations, skipped luxuries, saved diligently. Yet after accounting for inflation, many were actually losing purchasing power year after year. The numbers looked bigger. Their wealth in real terms became smaller. There's even a name for the blind spot that hides this from you. This is known as the money illusion. Humans naturally focus on the number of dollars they have, not on what those dollars can actually buy. If your account grows from $20,000 to $20,100, your brain celebrates. It feels like progress. But if prices rose faster than your savings, your standard of living quietly declined. The loss is invisible. No notification appears on your phone. No warning arrives from your bank. Your purchasing power simply fades away. And here's what should really bother you. What's remarkable is how little attention this received. If the stock market falls 20%, it's front-page news. Everyone talks about it. But if millions of savings accounts lose purchasing power by a small amount every year, because the balance never goes down, only the value behind it does. It's financial erosion in slow motion, and slow problems rarely create panic. So does that mean you should stop saving altogether? Not exactly. Here's the twist. Of course, this doesn't mean savings accounts are useless. Emergency funds are incredibly important. Unexpected medical bills, car repairs, job loss. Immediate cash can prevent financial disasters. The purpose of a savings account isn't to generate wealth. It's to provide stability and liquidity. The problem arises when people expect it to preserve long-term purchasing power during periods when inflation consistently exceeds interest rates. Those are two different goals. The real lesson isn't that saving is bad. It's that understanding the difference between nominal returns and real returns matters. A balance can grow while your buying power shrinks. You can earn interest and still become poorer. And an account labeled safe may not protect you from the silent force of inflation. And maybe the most painful twist of all is who this actually happened to. Perhaps the most emotional part of this story is that many of the people affected were the most financially responsible. They avoided debt. They built emergency funds. They saved consistently. They followed the advice they had been given for decades. Yet the economic environment had changed. What worked for previous generations no longer guaranteed that money would hold its value. The rules had shifted. Most people simply didn't realize it. So before you close this video, ask yourself one question. So the next time you check your savings account and see the balance has gone up, ask yourself one question. Can this money buy more than it could last year or less? Because that's the number that really matters. After 2008, millions of savers discovered a surprising truth. Their savings account wasn't growing their wealth. It was quietly losing purchasing power every single year. And the most astonishing part? It was never an accident at all. That outcome wasn't an accident. It was a consequence of an economic policy designed to get money moving again.